You need an investment that will pay you with income so you have money to pay your bills, travel the world, and do all the other stuff. You go to work or your business every day to get paid. For my male followers, I drew a mustache. In my native language Punjabi, we call it a much. For my female followers, I drew a braid. Which in my native language Punjabi, we call a gut. You go to work or your business to get paid, and now you have money. The first thing you gotta do is not spend all of that money. When you don't spend all that money, you're gonna have some extra money, and this is the money you wanna take and put away into this investment, which I'm gonna depict with this box. And the goal with this category of investments is you're gonna take this extra money, throw it here, and it's gonna pay you back with more money that you do not have to go to work to earn. When you go to your job, when you go to your business, you have to physically work to get paid. With these investments, you put your money here, and the money will keep paying you whether you're at work, whether you're traveling, whether you're sleeping, or doing whatever you want, because now your money is working hard to generate you more money. That's what it means to generate income from your investments. I want to show you 3 ways that you can generate this type of income, but I want to dispel any myths out there because there's a lot of lies on the internet where people will talk about how you can get this passive income without any money, without any work, without any effort. The reality is generating this type of income or any substantial income in this way is going to take work, it's going to take time, it's going to take sacrifice, and it's going to cost money. Okay? The 3 ways that you can invest your money and generate this income passively is through stocks strategically, real estate strategically, or through your cash strategically. When I say strategically for stocks, what I mean is that certain companies on the stock market will pay out a dividend. A dividend is a cash payment deposited into your account generally every 3 months, sometimes every month, for doing nothing except owning the right stock, because certain companies on the stock market like McDonald's have these big profits at the end of the year, billions of dollars of profits, and they can do 3 things with those profits. They can take that profit and save it for an emergency. They can take the profit and reinvest it back into the company to open more stores or make better burgers. Or number 3, they can just give it away to the shareholders, people like you and me, for investing in the company, and this money gets deposited into your account. Now, the problem with investing in McDonald's is for many people, you don't know how to actually research the company. You don't know if McDonald's is a good investment. You don't know if they're paying out a good dividend or if they're going to increase their dividend or not. And that's why for many people, investing in the individual company for the dividends isn't always very profitable, because you invest in something like McDonald's and then you find out McDonald's is getting sued, then the McDonald's stock falls, their dividend falls, and not only do you lose the income, but you also lose the value of the investment. That's why the simpler way to start is to invest in a dividend paying fund, because now you're investing in dozens or hundreds or thousands of companies that are paying out a dividend. And then if a company goes bankrupt or if a company starts to not do so good, that fund will kick that bad company out and replace it with another company, and it's completely passive for you. I'll give you a couple examples. SCHD is an ETF, meaning this is a fund created by a company called Schwab. And pretty much any brokerage out there will allow you to invest in a fund like SCHD. As a disclaimer, I'm personally invested in SCHD, but this is a fund that invests in high dividend paying companies in the United States. So instead of you going out and finding all of these companies, you can just invest in a fund like SCHD, which at the time I'm recording this video is paying out a dividend of slightly under 4% a year. And now if a company does bad, again, SCHD will kick them out and replace it with another company. But you have a lot of options here. Example number 2 is NOBL, Noble. This ETF, again, a fund, invests only in dividend paying companies in the S&P 500 that are dividend aristocrats. What does that mean? Number 1, these are companies in the S&P 500, meaning they are part of the 500 largest companies in the stock market. Number 2, they have to pay dividends. Not every company pays a dividend, and so this is specifically dividend paying companies that are part of the S&P 500. And then number 3, they're dividend aristocrats, meaning these are companies that have paid out and increased their dividend every single year for at least the last 25 years. So the whole idea here right now is paying around a 2% annual dividend. Is when you invest into here, is investing into companies that have been consistently paying out dividends and increasing their dividends year after year after year. So you'll hopefully see more income in the future because the companies are working to grow the dividends that they're paying out. And then the third example, again, a very different one, is VYMI. This is again something that I'm personally invested in. This is a fund created by Vanguard, but this is investing in high dividend paying companies outside of the United States. So this is an international fund specified on dividend paying companies because some of these countries and companies are growing, so you have more risk for more potential return. Not only is the company working to grow, but these countries are also growing, so you could see a win-win if the country grows and the company grows. but you don't have the same stability as the United States government or the United States economy, so it comes with more potential risk. And at the time of recording this video, it's paying out a dividend of a little bit higher than 4% a year. The second way you can invest for income is by investing your money into real estate. And I want to remind you that if you are an investor or want to become an investor, I put together a full and free investing masterclass to help you on your investing journey, to show you how we at our firm look for hidden investment opportunities before these investments hit the headlines. It's a completely free masterclass. We'll walk you through how we do it and how you can start researching investments better, hopefully. If you want to watch this investing masterclass, it's completely free. All you have to do is register, and I have the link for you down in the description below. And when you register, you'll also, as a free bonus, get signed up for Market Briefs, which is my free newsletter for investors. Again, the link is for you down in the description. So 3 investments you need: one for income, one for growth, one for protection. We're talking about income right now. We've talked about how you can generate income from stocks. Now let's talk about how you can generate income from real estate. Instead of you going out and buying a house to live in for yourself, you're going to go out and buy a house, maybe an apartment building, maybe an office building, maybe a storage unit to rent out to somebody else. In exchange for somebody else living in or using your property, you're going to get paid with rent every single month. And if you do this correctly, that rent payment is going to cover your mortgage costs, your property taxes, your insurance costs, your maintenance costs, your vacancy costs, and put some money in your pocket every single month. That is the correct way to do real estate investing. I know over the last few years, a lot of people got excited by this idea of, if I just buy a property, even if I lose money on it every single month, it'll be okay because my property value will skyrocket. Well, the housing market has slowed down significantly. But when I talk about real estate investing, I'm not talking about hoping that the prices of real estate are going to go up. That's speculation. When I invest in real estate, I'm looking for cash flow. I'm looking for income. What types of returns? Well, it's going to depend on where you're investing. It's very different in New York than it is in Nebraska. So you have to understand what types of goals you have when it comes to investing in real estate. And for me, when I invest in real estate, I'm generally looking for a 7% minimum cash on cash return. Meaning if I invest $100,000 of my own money, I want $7,000 of cash flow passively after all of my expenses, $7,000 deposited into my account every single year. And hopefully it will go up year after year after year. But there's a few things I also want you to understand about real estate. Number one, when you invest in real estate, it's going to cost more money than when you invest in the stock market. You can start investing in stocks with as little as $100, I mean, even $10. With real estate, you're going to need more money. There's a lot of people that tell you, oh, you don't need money. You can just do no money down. You can do just 100% finance deals. It's so much more risk and much more likely that you're going to fail, especially if you've never done the deal before. Maybe it works for a small percentage of people, but most people are going to fail when you do that. Number two, it is going to take more work than if you're investing in stocks, because if you're actually going out and buying the property, you have to find a real estate agent, you have to find a good attorney, you have to find a good accountant, you have to find a good title insurance company, you have to find a good contractor and all their team members to actually make this happen. Not saying it's bad, but you have to understand it's going to take more work and more time. And the other now things about real estate is when you own real estate is you own a physical hard asset. You don't have that here. When you invest in stocks, you have a piece of paper that says you have ownership in this fund or in this stock. Here you actually own the bricks, the land, and the windows. With real estate, you're also in control, because now if something's going wrong with the property, you can fire the property manager. You can make renovations, so you have more control. And with real estate, you also get some of the biggest and best tax breaks that our tax code has to offer. As a licensed attorney, who's not your attorney, what I can tell you is that real estate investors get to qualify for many tax breaks which allow you to make money and pay less or little money in taxes 100% legally, because that's what the tax code says. So yes, real estate is more work, but it also has a lot of wealth potential and a lot of tax protection potential, which is why wealthy people love investing in real estate. And this brings me to the third way that you can work to invest your money for income, which is through your own cash. I'm gonna go over 4 ways that you can generate income from your cash. Number 1 is to generate income by putting your money into a high yield savings account. Number 2 is a CD. Number 3 is investing your money to a treasury. Number 4 is investing your money into a treasury ETF. These 2, high yield savings accounts and CDs, are the simplest and most accessible way to park your money. I don't really like calling them investments, but let's just stick with the idea here that you're going to generate some interest on your cash. So if you have some extra cash and you have it sitting in a bank account, if you move your money into a high yield savings account, it's a bank. Make sure it's FDIC insured, and it can pay you many times more than what a regular bank will, just because it's a high yield savings account. At the time I'm recording this video, there are high yield savings accounts that are paying 4 to 4.5% a year in interest, while the average savings account is paying much less than that. A CD is a certificate of deposit where you're going to put your money into this account, but you can't touch it for a year or 5 years or longer. And in exchange, they're going to pay you with higher interest rates. I really don't like the idea of having my money locked up, but it is an option for some people if that is something that you're interested in, and most banks will offer that. Then we have treasuries and treasury ETFs. A treasury is a loan, but more specifically, it's a loan to the United States government. And every economics textbook will tell you that when you lend money to the United States government, it is the safest investment. It's risk-free because the United States government can always pay their bills. It doesn't mean they always have money to pay their bills, but they always have paid their bills. How? Because number one, the United States government can just raise taxes to pay their bills, or the United States government can work to get more money printed to pay their bills. So yes, the value of the dollar can go down because they have to print money to pay those bills, but they've always paid those bills. So you can generate interest by lending your money to the government by putting your money into a treasury. You do that by going to Treasury Direct and lending your money to the United States government. Or an easier way to do that is by looking for a short-term treasury ETF. For example, SGOV. SGOV is a short-term treasury ETF, and if you invest your money here, you're not going to see any growth in the value of your investment. You're just investing for monthly interest payments, and at the time of recording this video, they're paying out interest of around 4.5% a year. And if you look at the value of this ETF, it doesn't change in price. The only time that the price changes is when they pay out their monthly interest payments, but the price of this ETF is not changing. That's not why people are investing in this. They're investing in here just to generate that consistent monthly income, which is around 4.5% a year. There's a couple things I want you to be aware of. Number one, because you're investing your money into a treasury, even with SGOV, you get to qualify for no taxes on your state or local tax return when you generate money from treasuries or a treasury ETF. The other thing I want you to be aware of is it is not FDIC insured because you're not putting your money into a bank, but you're protected by the United States government. So if the United States government defaults, you're not going to get your money. But if the United States government doesn't default, you're going to get paid that interest. And finally, number three is you're not actually getting any growth in the value of investments. You are just working for interest, which is the whole idea here. When you invest your money through your cash, you're not seeing any growth in the value of investment. You're just generating interest out of that investment. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.